So you're telling me you want to give my money to someone else? Seems like I'm giving something away and not getting anything in return.
You're getting anything. You get the feeling good feeling in return, Matt.
What else you got? Hey, it's 5 Minute Finance. I am Ebenezer Scrooge. No, I take it back. I'm Matt Robeson. I am your host, and that was the very charitably minded voice of Mike Morton, your certified financial planner and all-around expert on all things financial. But we're not going to overwhelm you with expertise. This is the show where we boil things down to practical steps that you can actually get done so you can feel great about your money and lighten the load. Life is busy, especially at the holidays, and we got you. And this week, Mike, you want to talk about charity.
Charitable giving. We're at the end of the year, Matt. It's now the thing that is coming upon us after all the parties and stuff. We're recording this right December 1st. It is December 1st, yes. And man, it has suddenly gotten busy, the calendar. Has your calendar just like exploded when you look at it for the next couple of weeks?
I honestly, this is going to sound terrible. There's no way to say this without sounding like a total douche. So I'll just say it because whatever, I'm very on brand. My calendar is always so off the hook. Like, it's like all I do is drive my kids around to things. And so I don't even notice at the holidays. See, I sounded terrible. What about you? Can you sound less terrible?
No, that's how it goes every week. I was like, well, this week's very busy, and then it gets a little lighter, and then I just caught myself, and I was like, oh, really? The next, like the middle of December and towards the end is going to feel lighter. No, it's super busy between, not only the kids, the usual kid activities, right? But now you got holiday kid activities. Like they've got, things in school they're doing, right? Baking stuff. They're having their own parties. They're like getting together with their friends. So you got school stuff, you got kid activities, you got end of year activities, and it's just piling on, man. It's piling on. Here we go.
I have to admit something. Because look, I've already totally lost any warm and fuzzy feeling from the audience that they may have had about me for some reason. And after my Hanukkah rant in our last, can I admit something? This is, obviously I'm a Jewish dude, so I kind of feel allowed to do Hanukkah rants. But I'm married to a Christian. So I guess that entitles me maybe to make Christmas rants. All of this is going to go so badly. I don't like Christmas. I don't like the holidays. I am a Grinch. I am a certified Grinch. But I'll tell you something. I do actually believe in charitable giving, notwithstanding our cold opening a moment ago. I do think giving is awesome, and you want to talk about how to do it well.
You don't like Hanukkah or Christmas. You are fired off this show. You are Scrooge. I will see you again in January.
Yeah, I don't like January either. It's cold.
It just gets cold. Yeah. All right, let's move on. Charitable giving. Yes, this episode is about end of year charitable giving. We're going to go over some strategies. But more importantly, I kind of want to frame this, Matt, in the context. We've talked about this each year. Frame this in the context of family values and including the family in the charitable giving. So some of the things we're going to talk about today is exactly that. Family values and charitable giving. What is a donor advised fund? We're just going to hit that really quick. How charitable giving saves taxes. Donating appreciated stock, Matt. You can give away $50,000, but the charity gets $100,000. I'm going to tell you how that works. Bunching strategy and DAF for the win.
Yeah, that is organized. That is a huge amount of ground, but this seems like basically like a teaser episode. You're going to try and be comprehensive. We're going to go 30,000 foot view, all the things you need to know at this time of year when people are thinking about giving more. And that's super useful. And speaking of useful, we're going to do some more in our listener question. Speaking of giving, what's the best way for grandparents to give money to their grandchildren? That's going to be a useful one. We've also got a somewhat related worth knowing segment this week in which Mike is definitely gaslighting me, and it's going to be very painful. So you'll want to hang on for that, especially if you're still harboring ill will toward me from my previous comments about Christmas. And finally, we will hit our one thing segment where Mike has a mysterious thing to say about Starbucks and how they're maybe being a game changer. I don't know. I hate Starbucks. I hate a lot of things. I hate Starbucks too. So we might have a fight about this. This is a lot.
You're really in the season here, Matt.
You're a mean one, Mr. Grinch. All right, let's get to it. All right, let's get to giving, taxes. And you want to put this all in the context of values. That's the step back that you want to start with.
Yeah, that's right. I think this is a great time of year to think about why we're doing charitable giving, right? I mean, we kind of think about that. What kind of organizations do I want to support? Maybe they're local, maybe they're national, maybe it's very particular to, your circumstances or family circumstances. And I think that's a great way to remind ourselves, because I had the conversation, Matt, about, hey, how to do it, the logistics and the taxes and stuff like that. But really, we're giving to, support those organizations. And in particular, what are the family values? What kind of organizations do you want to support, and how to include the kids in the family and keep that the family values and the generational transfer of those kinds of things at the forefront, and how to make that a part of the season.
I would like to put in my 2 cents that I like the system that I think evolved out of one of these conversations between the two of us a couple of years ago that we've adopted in the last few years, which is we do, of course, make annual charitable giving part of the holiday season for us. Now, I mean, obviously, you want to give year round, but a lot of people, there's nothing wrong with concentrating more of it at the holidays. And, we'll get to the charitable, tax aspect later. A lot of people do that. So what we've just tried to do is make that a family decision. My wife and I pre-select some options for charitable outlets that we tend to like. And then we give them as a suggestion to our kids, but we also give them license to do a little bit of exploration on their own, especially as they've gotten a little older, and locate charities that they think are worthwhile.
Do the kids get involved with some of their money, or do you guys set the budget? It's your money you're giving away.
So it's interesting. That's a good question. It's something I've been thinking about increasingly because, again, partly to your advice, what we've done is we've switched from an allowance that's like paper money to a more modern alternative. We use Greenlight. That's not the only app. We're not sponsored by them. That's not the only app one has to use, but we've used that. It allows you to get debit cards. So the kids have debit cards and we can give them allowance. But we've done it intentionally so that they have spending money and saving money, and they're saving towards specified goals. What we have not yet done, but I think is a good 5-minute task for this year, is set up the options where it allows you to do some investing, some exploring and investing, and some putting aside money specifically for charities. We have recurring charitable payments that we do, my wife and I, but this, it's something that I've been thinking about. Like, would they, as part of this year's exercise, like to select one that they will give to year round, and it's out of their money, but it's a contribution that they're making.
Yeah. So here's what I've done in the past. I love that, Matt. I've done when my kids were a little bit younger, we did allowance. And we actually did paper money for when they were younger, because then you get to kind of touch it and hold it and kind of see it and put it in the piggy bank and the jar and stuff. And what I used to do is it was like, I can't remember the numbers, but say it was like $4 for your allowance and $1 that had to be for charity. But it's like, it was yours. I gave them the $1, but they had to put it in like a different bin. Yeah. And then it would collect in there throughout the year. And then at the end of the year, there'd be, $50 in there or something. And it's like, okay, great. Where do you want to give that money? So it was kind of theirs, but they were, I told them they had to put it into the charitable bucket.
Well, what I like about that is the physical immediacy of taking money and putting it away for charity. That's a lot more, I think it feels more psychologically impactful than just seeing an account. Yeah. That said, I mean, they're digital natives, this generation. Yeah,
exactly.
So it might be as real to them. That might feel more significant to me, but it's really not. But I like that system too.
And I'm going to take another page out of your books. Oh, here we go at the end of this segment. I'm going to be the Scrooge in my family. I just realized I have been getting them digital money throughout the year, but part of that was supposed to be earmarked for charity. So now I get to come to them and say, hey, you know what? All that money in your bank account, yeah, $50 of that's for charitable giving. So we have to figure out where that's going. So I get to remind them of that here. And here's my 5-minute task. 5-minute task that I'm going to do today is put on my calendar when I'm going to sit down with the family and go over all of this. Say like, hey, how much money is it that we're going to do for charity? What are the charities that we want to do? How are we going to do it? Have that discussion. So I'm going to set today, I'm going to find the time in the next few weeks where we can sit down as a family and have this great discussion.
You want to touch on donor advised funds. This is one of the great insights that you've delivered on this show. We have a whole episode on this. It's in the archive. Really recommend it to people, but could you give us like the thumbnail?
Yeah. Donor advised funds are fantastic. It is an account that you own. So you set it up, a couple of clicks. You can get it at Fidelity, Vanguard, Schwab. Highly recommend setting up wherever you have your brokerage account. And so in a couple of clicks, now you own a donor advised fund. And then you can put money into this account, just like any other account. You can transfer some money into it. What it is, when you transfer money into the donor advised fund, that is your charitable donation right at that time. So whenever you transfer money into that account, you get the charitable deduction at that time. But it still sits in the account in your control. You can invest the money kind of like your 401k, a menu of options, how you can invest it. And then you can give money to charities from the donor advised fund. Now, when you give it from the donor advised fund or the DAF, that's not a charitable deduction because you got it when you put the money in. Okay. So that's how donor advised funds work. It's your account. When you put money in, you get the charitable deduction, and then you can give money out at any time throughout the year from that account.
There's a level of complexity that we promised people we would not go to on this show. But boy, it's tempting hearing you say that to combine the first thing we talked about with the second thing we talked about and have the kids' allowance, whatever money we're giving them, have a portion of it go to a donor advised fund that then at the end of the year, we could talk about where it goes, but then, it just kind of automatically accrues throughout the year. But anyway,
absolutely.
These are great. And the rundown, again, I can't recommend it more highly. It was really eye-opening how you could become like your own charitable foundation. And it's really fantastic. Let's touch on the tax thing for a second, because this is, I've been doing this show with you for years. I have a degree in economics. I feel as reasonably competent to handle taxes as I guess one can feel. I still don't fully get it. Just help me with the charity and taxes thing.
Yeah, totally. So here's the way taxes work when it comes to charitable giving. All right, let's go through taxes really quick. You get gross income, all the dollars that you make. And that might be $200,000. And that includes capital gains and dividends and interest and your salary, like just all the money that you kind of gain throughout the year. And then what you get to do is you're not taxed on that total. First, you get to have a deduction. All right. So 200,000, you get a standard deduction of like 30 grand. And so now you're only taxed on 170,000. 200,000, all the income minus the standard deduction, then you're taxed on the 170 grand. Charitable contributions come under itemized deduction. So you get the standard deduction of 30 grand, or you might itemize deductions, okay? And whichever is bigger is the one you want, all right? So because you want a bigger deduction off of that total salary. And so charitable contributions come under itemized deductions. So if you do not itemize, if your standard deductions higher than your itemized deductions, you don't get a tax saving from your charitable contributions.
And every year, I'll admit, we go through this where, it's not like we give nothing to charity. We do give to charity, but, we take our charitable deductions and the other things that are deductible, medical expenses and, home use, use of the home for business purposes, all the things that you can itemize. And we add them up as an exercise every year. And the answer is always the same. Take the standard deduction.
Yep.
The standard deduction.
Not this time, though. 2025, Matt, I will be curious, but probably this year you will itemize because of the SALT. We're not going to go into it now, but the SALT, they changed it. The one big, beautiful bill changed it. And people that live in high cost areas with big homes and in the blue states now are going to get a higher itemized deduction.
That is very, okay. Well, I'm glad we touched on this then.
And I'll also say this, there's also slight changes to how charitable deductions work. You don't always have to, for the first 500 or 1,000 or a couple thousand, the first little bit, you don't have to itemize. You get them as well. So be on the lookout for some of those changes.
All right. No, that's great. So the bottom line here is if you had in mind of like, I don't really have to track this. I don't really need to worry about it. It never counts. This year it might. So pay attention to it. That's great. All right, cool. So you also did an episode once with me about donating appreciated stock.
Yeah.
Right. Let's hit that one real fast.
All right, here we go. So this plays in the donor advised fund. All right. So you can give away just $50,000, but the charity gets 100,000. Here's how it works. You have a stock that's gone way up in value and it's now worth $100,000. Maybe you got it from your parents years ago. Maybe you invested 20 or 30 years ago in some individual stocks and now it's sitting there. It's worth $100,000. You donate that stock to your donor advised fund. This is very simple, a couple of clicks. Another reason we love donor advised funds. All right, a couple of clicks and you've put the $100,000 from your brokerage account into the donor advised fund. So you think, wow, I just lost I just gave away $100,000. Great, supporting, my causes and all that stuff. But I gave away 100, but you didn't give away 100. One, you're going to get to take that off your taxes. We just talked about that. 100,000 comes off of your income. You subtract the 100 grand because you're itemizing. So you save $30,000 in taxes. I'm just keeping the math simple. Okay. 100,000, you just saved 30,000 in taxes. So you really only gave away 70 grand. But you also did not sell that stock to turn it into cash. Like if you wanted to go and buy something like a car, you'd have to sell the stock, right? And you have to pay capital gains, but you didn't have to do that. So that's another 20 grand that you saved in capital gains tax. So literally you only gave away 50,000 of purchasing power, but the charity gets the full 100,000. This is why taxes and tax planning is so critical. It adds up to real money.
Bunching. This is a great strategy if you're in the NFL.
Yeah, that's right. So this gets back to your point, Matt. Let's go back to your point. This is a great example. You said every year we give away some charitable donations, but it never added up enough to push us over these standard deductions so we didn't get a tax break. So Matt, you could have done this if you tuned into my podcast, if we had one 4 or 5 years ago. What you do is you bunch the charitable donations. You say, we're going to give away 5 years worth into our donor advised fund. So if we normally do 3,000 a year, we're going to do 15,000 this 1 year into the donor advised fund. And that pushes you above that standard deduction. So you get a deduction from your charitable contributions. And then every year you give 3,000 from the donor advised fund like you were going to do anyway. Okay. So that's the bunching strategy, is that you take multi-years worth, put it in the donor advised fund to get the deduction, the tax deduction. And then you give out what you were going to anyway from the donor advised fund.
And you might do that if you have a particularly high income year where you're going to face higher taxes.
Absolutely. Yeah. It's a great idea.
So bottom line this for me, donor advised funds are great.
Donor advised funds for the win. Yeah. Last thing, just again, hitting on the donor advised fund, the last thing that people come back to me, and I hadn't thought about this, it's the simplification and being organized. When you're using a donor advised fund, all those charitable donations you have to track for tax purposes, they're all in one thing. It's like, hey, I just put them in the donor advised fund. I just have to go back there. I want to give out, what did I give out last year? Keep us organized. Boom. It's all like listed. Here's the organizations we gave to, et cetera. So donor advised funds are useful for a variety of purposes.
Wow. That actually is great. We maintain a Google Doc. It's, I'm sure the IRS thinks that's equally valid.
Equally valid, yeah. So 5-minute task on this one, guys. If any of that struck you, if you're like, oh yeah, I should be using a donor advised fund, go ahead, log in, open up a donor advised fund. Literally these places make it a couple of clicks. And please, public service announcement, don't give away cash. give away appreciated stock. Do not donate cash. At least save yourself a little bit. Always donate appreciated stock. So use the donor advised funds.
All right. That is a really great comprehensive 30,000 foot view of the charitable landscape. With that, let's move on to our listener question. All right. This week's listener question is, this is the beginning of the gaslighting. You're gaslighting me. People need to go back and listen to our last episode, and you'll start to get the joke of what Mike is doing to me this week. I don't know why you chose this listener question. I have my suspicions. All right, here it is. My parents want to give money to my kids. What's the best way for them to do that?
It's a really good question. It's hard to answer without knowing a lot of context, right? Are we talking like a few $100s, a few thousands of dollars? Like how much have you saved? You know, a bunch of stuff. So I'll just give you some generic things to think about. If it's small amounts of money, I do recommend opening accounts in the kids' names, you know, a savings account or a checking account, give them a debit card, you know, if they're at the right age to start using some of their money, spend some of their money. We've had episodes about that. So, you know, I highly recommend doing that kind of thing. If it's larger amounts of money, there's a few things to consider. 529s are great. Hey, we're going to have college expenses, you know, maybe the grandparents can throw it in a 529, invest and grow for the college expense. That's always a great use for some money. Even birthday money and other stuff, you know, is great in a 529. You can also just open up an account that's earmarked for the kids. I do this with a lot of clients like, hey, I want to start saving some money for a down payment for a house or their first car or, you know, and so we'll just open an account and throw in $50 a month or whatever they can afford to just kind of chip away at savings. You'll be surprised how fast that can grow, but just keep it simple. Just open an account in your name, click open, you know, set up the automatic transfers, et cetera. And finally, you can open up the UTMA or UGMA account, which is transfer to minors account. Very straightforward. They're easy to open, but remember, they have a lot of rules. It is going to be the kids' money when they turn 18 or 21. So just make sure you're prepared for that.
I think it does go back to what you said at the top, which is what's it for? You know, is it $25 for, you know, like go get yourself something nice. It's Christmas. Or is it, you know, $2,000 because I really want you to be able to go to college. And, you know, and if it's for college, I just like all the 529s. Now you have the capability you can send a link. This is what I do with my mother, for example, and they can just do it directly. And if the link doesn't work, you can send them the information. They can send in a check. I
was curious, Matt, how often do you send that link to your mom?
3 or 4 times a day. You know,
yeah, cool.
And the reason I do it that way, the reason I do it that way is because of our Worth Knowing segment, where the gaslighting of Matt Robeson continues. Because in our Worth Knowing segment, brought to you not really by my Substack, worthknowing.substack.com. That's where you can get my writing, my videos. I have a new show, by the way, where I do a really fun video segment called That's Bullshit, where I call out some of the pervasive bullshit in American life. It's really fun. Anyway, for this week's Worth Knowing segment, you wanted to talk about how to prevent dementia. And I should explain my little gaslighting joke, because last week, in our last episode, you wanted to talk about how to have really difficult conversations with your parents, like, hey, Dad, you're slowing down, and you probably don't remember that we already had this conversation 3 minutes ago. So why don't you give me all your money now? So I just love the way you set up this week's listener question so that it's how your parents can start the process of giving money. And then the second part is the Worth Knowing segment, which is about how to prevent dementia.
Yeah. And we could just keep going back and forth. Give money to the kids and prevent dementia. Oh, and don't forget, give money to my kids.
Yes, exactly. So how do we avoid that? How do we break out of this loop? You want to prevent dementia? I actually would like to know this.
Yeah, this was worth knowing. I ran across this article at the Wall Street Journal. We'll link it up in the show notes. And I thought it was great because it's this idea of just like little habits and stuff to set yourself up for success. Matt, you and I are not getting any younger. I mean, we're trying to, but it's not working so far. So here's the quick rundown. You need to monitor, some health signs, monitor blood pressure and cholesterol, keep those things in check. Don't smoke. You have to exercise. The one thing we know, even just small amounts of exercise make a big difference. Sleep. And this one is critical. Your hearing. And I know this is critical. Like as your hearing starts to go, or in the future, let's say, you really want to get on top of that because you'll kind of start tuning out. You might have seen this with some other parents or, some other adults. You'll start tuning out a little bit like, oh, my hearing's not as good. And when there's a conversation going on, you won't be as involved because you can't kind of keep up with it. So really, if you find your hearing starting to go at any level, get on top of that because you want to stay involved cognitively with conversations.
Oh, that's really interesting. I'd heard all the other ones before and they seem kind of par for the course. Yeah. I'd never heard the hearing one. And that actually, now that you say it, it makes total sense. Like the more you're tuned in and actively involved and cognitively processing everything going around, the better off you're going to be. All right. That's great. That was really worth knowing. All right. With that, let's do our one thing. All right. I have no idea where you're coming from on this. You want to talk about Starbucks? I'm going to fight you on this, no matter what it is. If it's something good about Starbucks, I'm against you. But go ahead, try it.
All right, this is a game changer for me. Starbucks introduced protein drinks, and I loved it. I was like, protein drinks. They have vanilla. I like the vanilla lattes. I'm a fan of vanilla lattes, and they have the protein vanilla latte. And I tried it, and it was shockingly great. And has a lot of protein in there, which I'm always trying to, find little ways of getting protein here and there. So that was a game changer for me, guys.
All right. Several questions. One, do they burn the protein drinks as well?
They're the same as all their other drinks, and I am a big fan of their drinks. So you can bash them all they want, but have you had any of the drinks with the cold foam on top? This is another game changer they introduced like a year or more ago.
I don't want their disgusting foam on top of their burned coffee.
You're incorrect. You're incorrect.
I am?
Yes.
Oh, no.
They spend a lot of effort, just like all fast food chains, on how to create, delicious items. And their thing is like these layered drinks are outstandingly delicious.
Okay. We know everything we possibly could know. And as you could tell, I am very, very hepped up on some kind of coffee that is not from Starbucks. So everyone have a wonderful, wonderful Christmas, Kwanzaa, Hanukkah, holiday, whatever it is you celebrate. And we will see you next time.
Thanks, Matt. Thanks for joining us on 5 Minute Finance. If you like what you heard, please subscribe to and rate the podcast. It makes a huge difference for my show. You want more? Find Morton FA on Substack. If you have a comment or question, please email pod@mortonfa.com. Until next time, thanks for tuning in. This recording is for informational purposes only and should not be considered for investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. I cannot guarantee the accuracy or completeness of the data presented here.